for sticking around for this final act of the afternoon. Cathie Wood is here. And we were just talking backstage. I haven't seen you since pre-pandemic, at least in person.
That's right.
And so much has happened to you and to ARK during this period. It has been a remarkable ride. And just to put it in perspective, you started ARK in 2014. Dare I say, you were 57 years old at the time. You don't look any older now, but she had no assets under management. Today, at age 65, she's at the peak, I would argue, of your career, but I hope there's more to come. And you're managing something on the order of $85 billion, which is a pretty remarkable thing. She has been called on social media, and I hope this isn't considered sexist or something else, Mama Cathie. They call you Aunt Cathie. And then in South Korea, they call you Money Tree, which I love. And this is what Art Laffer, who you used to work with, said about you. The thing that's amazing about Cathie, even back then when he was working with you, her horizon is forever. She wasn't in it for next week or next month or next year. She was in it for the long haul.
Yes.
And so I want to start with this before we even get into what's going on in the markets today. Mm-hmm. This is just an investment sort of horizon thesis question. When you think about the quote unquote horizon for your fund and the way that investors who invest in your fund should also think about that horizon, what is it?
Well, in terms of our investment time horizon, 5 years. So we have to believe that one of the technologies, the 14 technologies around which we have based all of our research, is going to inflect within 5 years, or at least be discounted in the start to be discounted in the market as though it is about to inflect. So 5-year investment time horizon. Our minimum hurdle rate of return is 15% at a compound annual rate over 5 years. And so I think that that combination of 5 years plus exponential growth trajectories is what is finally starting to get into the market. I've been waiting for years.
I know you've been waiting for years. So to put this in perspective, the fund over the last 2 years is up about 164%, give or take. Year to date, it's down a little over 3% at a time. We all know the S&P 500 so far is up a little over 18% this year thus far. So put it in perspective, where are we in this market given your 5-year horizon?
I believe we are seeing, it's going to be incredibly confusing, I think, to people. Just look at what's happened to the bond market this year. You know, against all expectations, yields have dropped from, I think it was 1.75 at the peak in March down to 1.3 as inflation expectations are exploding, right? We believe the reason for that is that we're probably, when all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world. And we see 3 sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up. And artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another, explosive energy, incredible deflation. That's the first deflation.
While the rest of the world thinks, I mean, if you were here for part of the day, everybody's talking about inflation.
Oh, and that's what I love. You know, if the whole world thinks that's going to happen, and a portfolio manager and analyst team thinks that's going to happen, well, if we're wrong, it's not going to matter that much, right? Because nobody's expecting it. It's not in the market. But if we're right, the returns are enormous. And I think that's what's going on with the technologically enabled innovation that we see, especially in healthcare, by the way. But there are 2 other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other two. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushback on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. Because
you believe there's a chip shortage.
I do believe there's a chip shortage because the world's going digital. But I believe.
But wouldn't that be inflationary?
Well, I believe chips are the new commodities. That's the point I'm making here. So chips are going to be what Dr. Copper has been in the industrial world. This is Dr. Digital, I don't know, in the form of chips. But you hear the auto industry screaming. You know, auto sales have dropped from 18.5 million units in April to 13 million. Now, these are annualized rates in August. That's more than a chips shortage. What happened last year is people bought the cars. They're in their driveways, garages, didn't want to take mass transit. And now there's a decision. What do I want to buy? A gas-powered car or an electric vehicle? Well, that's where the short supply is. And I think the excess supply is going to be in the gas-powered side. So this is a really important test case of why I formed the firm when we did. I think the disruption is happening to the auto industry now.
I want to get into Tesla, obviously, and a number of your picks in just a moment. But I do want to just note, Morgan Stanley, Citigroup, Deutsche Bank, Bank of America, these are all firms that have published notes within the past month, effectively saying the opposite. Most of them believe that we are expecting to have inflation and, I think across the board, either pullbacks or much flatter returns.
Right.
You just think they're off. You think they're wrong.
I think, as I said, if you're looking at the traditional benchmarks, they may very well be right. All I know is when we are looking at the transformative growth that's going to take place in our space, and we're completely devoted to nothing else but disruptive innovation, we see explosive growth. I think one of the reasons they will look right in terms of GDP is if the other side of disruptive innovation is creative destruction, well, what's happening? It's the industrial world evolving into the digital world as more of the physical world goes digital, transportation importantly, right? And so the traditional benchmarks, GDP, the statistics that we look like are probably going to look pretty lousy at times, I would say. Certainly sector by sector as these transformations take place.
What do you think the role of millennials and the next generation will be? And I ask this because I've seen you make comments about demographics, both in terms of the role that millennials play in terms of the actual economy, but also the role that they may play in the markets themselves. Because a lot of people look at what's happened over the last 18 months in this new generation that's now in retail, often in your fund, on Robinhood, on Reddit, and think something has changed. Some people think it's tulips. Other people think it's forever.
Well, we just learned from Jolene Caruso that millennials are 70 million strong in our economy and now bigger than the baby boomers as a demographic. And I'm going to harken back to Stan Salvigson. Most of you won't remember who he was. He made one very important call in the early 80s. He said, baby boomers are going to be the reason that the equity market goes up for the next 20 years. it was a brilliant call. He's no longer with us. We're in the echo now. And I do believe that both crypto and the equity markets are going to be powered by millennials. In fact, Tom Lee at Fundstrat, he has done the arithmetic the way that Stan did. And I think he says this bull market will not end at least until 2026, and maybe not until 2038 when the number of millennials peaks out there. Well, I went through it in the 80s and 90s, and nobody believed him, thought it was a ridiculously simple call. But when you look back in history, it was a pretty good call.
Okay, I want to get into meme stocks and that whole phenomenon in just a minute, but I want to touch on a couple of your big investments and also touch on one other theme, which is China, because it's in the news. Mm-hmm. You have been thinking about that space or that region in a big way, or that country, I should say, in a big way. And I know you've reduced some positions, but what's your overall thesis at this point on China and what we're seeing in terms of this regulatory crackdown, which seems to be worse every single day?
Yeah. I think there's something going on there socially that the government is very worried about. Many of the same things that the rest of the world is worried about, whether it's the divide between the rich and the poor. I saw today Evergrande. There are protests around the Evergrande offices because the wealth management products that weren't highly regulated are not paying interest or not paying back and so forth. So I think there's social unrest taking place there. And that's why common prosperity has become the rallying cry, and hostage to capital has also become a rallying cry. So I don't think it's a very friendly place for capital now. However, focused only on innovation, China has, in its various 5-year plans, made innovation an incredibly important plank.
Right.
And so we don't want to avoid it, but what we do want to avoid is very high margin companies. So you look at JD Logistics or JD.com, some of the companies that are pushing innovation and access into tier 2 and tier 3 cities will play with that. So what we did in the series of moves recently around China, we have taken our position down significantly, but stayed with a few of the low margin.
What would it take for you to turn?
To
invest more? What would you need to see?
What would I need to see? I think it would be Xi Jinping saying, whoops, we made a mistake, we're open for business. I don't think he'll do that. So I don't think we'll be hugely involved with China. The other thing that I think is, and we've seen this in the crypto space, by shutting open source movements down, which is what they're doing.
Right.
All open source movements, no. I think this is going to give the U.S. a competitive advantage. So we have allocated more of our innovation assets here in the U.S. because of what's happening. China was going to be one of our biggest competitors. We saw them in the AI space, making the league tables in chips. I'm not so sure. I think they have to do some house cleaning right now that we probably do not understand all the causes, but I think there's social unrest. That would be my guess.
And you think, let me ask this, do you think that the regulatory environment there is either going to open up opportunity in the U.S. or will it give and embolden regulators in the U.S.
to shut it out?
To shut down what's happening here? Because it used to be that the big tech companies in the United States would say, well, no, you can't shut us down because look over there in China. Those companies are so big, we need to compete with them. But if they're being shut down or cracked down upon, will it just embolden Washington here?
It's a good point, but I think this is much more than China. As Rupal on the last panel said, France is becoming very innovative, and Southeast Asia has stolen the march from China. So companies like Sea, it's a social media, social commerce, gaming company. It's exploding throughout the world, and capital is shifting towards that kind of name because there are big populations in Southeast Asia and Latin America as well.
Okay, can we talk about our favorite topic?
Tesla.
Yeah, let's talk about it. And we have sparred over the years. I love Tesla. I've never loved the valuation of Tesla. and you have loved Tesla and the valuation of Tesla, and you've liked the valuation even at much higher levels. And I have always thought, as you know, that that's crazy, and you have been right. So here we are. You still believe that this is a company, that the valuation long-term is $3,000. That's your price target.
That's our base case.
That's your base case.
Yeah, that's not even our bull case. But let's just stick with the base case from $700.
3,000 by when?
5 years. Always 5 years.
Always 5 years. Mm-hmm. You recently sold some last week, right?
Yes.
About $180 million.
I read that it was 130 million. So it got so much press.
Oh, I'm sorry, 180,000 shares at $130 million, right? Why'd you do that?
So Tesla is still the largest position in our portfolios. On that particular day, and I can tell you this because we disclose our holdings every day and we publish our trades every day. On that, I'm always looking for cash in especially the flagship fund, which is very concentrated and involves all of our technologies. So a company in the automation space, UiPath, was down 11% that day on its earnings release. And Tesla had just gone up 30%. So it was really a tactical move. So just to give you a sense, Tesla is I believe it's 10.5% position in the flagship fund. The next highest position is, I think, 5.9%. So the conviction, I will take a trade up 30%, down 10%. That's like a 40% difference. That's all that was.
But this is not a stock, I mean, at least recently, that has been on the move higher. In fact, it's been flat to down. So
no, it's actually, if you look at it, it has been levitating. It has. We got into the 500s. It got well below 500, I believe, in the.
But I assume, therefore, but it must have crossed 10% a while ago. Meaning, you must have been much higher.
So when a stock moves from 10%, we can no longer buy. And thank you. I want to address this because we keep getting questions about it. We cannot buy a stock if it is 10% or higher in the portfolio. We can sell, of course. We do not have to sell. And what we usually do, this is not science, very unpredictable. So, you can't replicate this in terms of trying to figure out what we're going to do. But when a stock gets to 11 or 12% in the portfolio, that means it has appreciated by 10 to 20% relative to the other positions in the portfolio. And usually what we're doing is being opportunistic and taking advantage of a drop in a stock. Again, need the cash, largest position above 10%.
Okay, let me ask you.
Does that make that?
No. It makes sense. I know there will be bulls and bears on this. Let me ask you a different question, though. And it's really about how to assess and think about some of the comments, projections, and other things that Elon Musk makes about the company, and how you interpret them, and how the public interprets them, and frankly, how bears interpret them. Which is to say that there's a lot of times where Elon will come out and say something, whether it be about robo-taxis or when there'll be full autonomous driving, or all sorts of things that I imagine at some point, because we've had these conversations in the past, do get baked in or should be getting baked in to some kind of assessment of the stock. And as optimistic as you can very well be about all of those things, they haven't come true. And so how do you grapple with that?
This is one of the hardest problems that we are going to solve technologically. So actually, in the last 3 months, we have increased our projection for autonomous taxi networks. Now, in the $3,000 base case, we assign a 50% probability to autonomous. So it's a really hard problem. But if anyone is going to solve it, our confidence that Tesla is that company has gone up dramatically as we've learned more about it. But I guess
when I ask it, when Elon says that robo-taxis by the end of 2020, when you project, what numbers would you therefore have put in 2019 when he said that, or 18 when he was saying that?
Yeah, again, 5 year.
I know.
Our probability last year, or whenever he said that, was lower. I think we had a 25% probability.
So do you discount what he says by what number? That's
Elon, if you really look at what he's doing at SpaceX and at Tesla, he's changing our world. Right?
You're not going to get me to disagree with that. I think it's simply about the valuation and how investors should think about these numbers.
He was the first person when we were talking about autonomous taxi networks, he said the last mile is going to be so hard. I'm not sure it can be done. This was about 5 years ago, right. maybe longer. The resources that he's putting into this program and the talent that he's attracting and the advancements that he's making and that are possible now that artificial intelligence training costs are dropping by 68% per year. We think the probability of autonomous is going up.
I don't disagree, but does it frustrate you?
No, he's a visionary, and he sees the future so clearly. Right. The fact that he changed from saying last mile, I don't think that's going to, there'll have to be some combination system. He changed from that with his partner, Andrej Karpathy, right. who is one of the most brilliant artificial intelligence engineers. I think this is going to happen in the next few years. He is always a year or 2 or 3 too early. We adjust for that in our forecasts.
What do you think about the prospect that one of
and by the way, may I say one other thing? One of the reasons Elon does that is he wants to get the supply chain in motion. And when the supply chain does not cooperate, he brings it in. He's becoming much more vertically integrated. So auto suppliers and technology companies know that if they don't march to his drum right. and at his cadence instead of these 4 to 5 year design cycles, they're going to lose the business.
A lot of short sellers have lost a lot of money betting against Elon, mm-hmm. as you know. Mm-hmm. And one of the things that a lot of short sellers will tell you that they missed was not actually the technology or anything else per se, but was the scale and ability to go back to the market over and over again to get more and more capital. Mm-hmm. That the scale of the capital unto itself that could become almost a self-fulfilling prophecy if there were people out there willing to impart their capital to you over and over again. Mm-hmm. How much of that is in your thesis?
Well, the way we would frame that is we believed that Tesla had 4 barriers to entry, and all but 1 have increased in the last few years. So they have the artificial intelligence chip. They have the best battery technology, costs lower and will be lower for the next 3 to 5 years. They have the most data to do the right. training and find corner cases. And then the last one, which I would have thought they would have lost already, is over-the-air software updates. I haven't had to take my Model 3 in right. since 2018. They have the best cars on the road.
So your base case is 3,000. What's your best case scenario?
The best case is about 4,000 because we will never go to, we won't go to 100% in that autonomous, but let me give you the dynamics there. If you had asked me last year, I would have told you that the autonomous taxi network opportunity in the year 2030 would be a $6 to $7 trillion revenue opportunity. We have in the last year raised that to 10 to 12 trillion, and it is because before we had been modeling as though the costs would drop to where they should, given competition, which is 25 cents per mile. Right now, it costs us 70 cents per mile to drive our own cars. We are learning, and it's through Uber and ride-sharing services, that convenience matters a lot and not having to drive matters a lot. And so our price for the robo-taxi service has gone up from 25. I think we're up to, it's either 50 or $1 per mile.
Okay, new topic. Our other favorite topic. You know what it's going to be? Bitcoin.
Bitcoin.
5 years from now, what's it worth?
If we're right and companies continue to diversify their cash into something like Bitcoin, and institutional investors start allocating 5% of their funds towards, I'll just say Bitcoin for right now, because we did that, we framed it for Bitcoin, could be for other cryptos as well. We believe that the price will be tenfold of where it is today. So instead of 45,000, over 500,000.
If you could own Bitcoin, Ethereum, or some other crypto currency, and you could only own one, which would it be?
That is becoming a harder and harder question to answer. I think I'd default still to Bitcoin, because countries are now deeming it legal tender, and we haven't even put that into our thinking. Ether, however, is seeing an explosion in developer activity thanks to NFTs and DeFi. I'm fascinated with what's going on in DeFi, which is collapsing the cost of the infrastructure for financial services in a way that I know that the traditional financial industry does not appreciate right now. So it does have to move from proof of work to proof of stake. That transition is underway and seems to be taking hold. So here's how I'll answer that question. Our confidence in Ether has gone up dramatically as we've seen the beginning of this transition from proof of work to proof of stake. We'd still probably do 60% Bitcoin, 40% Ether.
For all of that to happen, do regulators, especially US regulators, need to buy into this in a major way? I would also say that we just saw it in the last week. Brian Armstrong runs Coinbase. You have a stake in Coinbase, has now gotten into a somewhat bitter feud with the SEC over how the ability to offer effectively a yield product on some of these cryptocurrencies, specifically Bitcoin, will work.
Yes. I think regulators, our working assumption from the beginning was that, and this was based on meeting with them, meeting regulators, both state and local and federal, was that no regulator wanted to be blamed from preventing the next big technology breakthrough to happen in the US. And that has proven true. Now we've got Chairman Gary Gensler. I'm really happy he understands crypto and understands the merits of Bitcoin in particular. He is a regulator, though, and he's a hardcore regulator. What Coinbase did, I mean, I was shocked when I saw Wells notice. Are you kidding? They haven't even released the product. Like, what is this? And I think what that Wells notice is doing, it's a call out by regulators saying, we got to discuss this stuff because this is happening very quickly. And I think we are going to bring courts into the system. This happened in Canada. A company called 3iQ sued the regulator there and won in court. So they were able to issue Bitcoin ETFs and closed-end funds and Ether as well. So I am beginning to think that Coinbase doesn't mind this at all. And if you saw the stock reaction, it hardly budged, right?
We're going to have to wrap up in just a minute, but I do want to talk to you a little bit about the social media-enabled phenomenon that is happening about it, and it's impacted your fund, and it's impacted the interest in all of this, Diamond Hands and the like. What do you make of that? And also, how do you think about your own responsibility in the context of one of the things you do, which is so interesting, is you are transparent in terms of what you're doing every single day. People see what you're doing. There's also people that are therefore trading off of what you're doing, and how you think about that.
I'll start with the later one. Was the first one about meme stocks, or was it?
Yeah, it wasn't really a question, but it was in the context of just thinking about what's happening here, and all of the whole sort of new generation that seems to be talking about these stocks. Some saying things that are factual, some saying things that are not factual, some saying that they want to have less regulation so that they can do more. It's a very different world than it was post-financial crisis, where everybody said that the job of the financial industry was to protect, if you will, the little guy, the little investor. And now I think the little guy is saying, don't protect me. And in fact, by protecting me, you're not protecting me at all, because what you're really doing is protecting the suit, the big guy.
I think it was on your show this morning, wasn't it, that Robinhood's
Yes.
legal counsel said something like that? Mm-hmm. It's really insulting to these people that you are going to protect them, right? Okay, that was pretty interesting. And so I'll first talk about the trading around what we do. I have been managing money since 1990, so for 31 years. And I've always had other investors or speculators shooting against us, because guess what? Even when I was managing separately managed accounts for wirehouses, I would be posting models. That word would get out there, what we were doing. When we posted our models out there, it would get out, and lo and behold, these stocks would take off. So I've been managing with that in mind for years and years. And so we don't have to buy a stock. If someone wants to take it up 20% the day after we buy and we haven't finished our buy, I'll finish it another time, because I know disruptive innovation is inherently controversial and we'll get another shot. In terms of what's going on now, I mean, I so admire the millennial generation. Yeah, as you say, I'm sure there are people trading just because their friends are trading. But the hunger for knowledge that they have, and the gratitude to us for the kind of research that we put out, the depth of our research, our tweets, our analysts are all tweeting. We have to be, we're on the right side of regulation. We know what we're doing there. We have someone from the SEC who became our CCO. So their hunger for information and their gratitude, it has been extremely humbling in a way. We get a lot of people coming up to us and thanking us for that, because we've opened their eyes to a new world. Let me give you a bit of a difference. When my children were in high school and college, I was trying to teach them about the stock market. I was trying to get their interest. Nada. It's almost like crypto had to happen. That got them interested. And to the extent they were looking at our research around crypto and others, they're educating themselves, and they love education. It's one of our mission and values. So, we meant to do that not because we knew this was going to happen, but because we want parents and grandparents and the children themselves to understand how rapidly the world is about to change, and to get your children, grandchildren, yourselves on the right side of change, whether it's investing or your education or your career.
Okay, a couple quickies. Do you own any NFTs?
I do not, but I gave one as a birthday present to Sig Sigalis, Chief Investment Officer at Jennison Associates. He turned 88, and he thinks it's the best present he's ever gotten. Angie Dalton, I don't know if you know her, from Sigmund Capital Growth, and I did. We split it. And his grandchildren now get to do layers of art on top of his digital art.
Do you think there's a bubble in NFTs?
Well, when I saw this original $69 million piece, I thought, okay, this has gone too far, too fast. We're now talking about the creative world. And when I heard about Async Art, I don't know if you've heard of that company. Async Art has developed a digital ecosystem where artists can put out their digital art, and then anyone can buy pixels, and change it. And so you can do layers, and the original artist gets paid. I was walking when I heard the CEO tell his story, and my smile went ear to ear, because I said, oh man, this is going to be so explosive. This is how I felt when the internet first came about, like, oh man, this could be really big. Remember when everybody said, what's the internet? I had the same feeling here, because, creators, they don't get paid for, every iteration. So.
Robinhood, you own a stake.
We do. It's a 1% position. Yes.
What do you think long term?
Again, we're into the millennial generation.
Payment for order flow.
Payment for order flow. I'd be shocked if it goes away. I agree with the general counsel, because it has been so good for zero commission trading and so forth. And you can look at the spreads and you can analyze exactly who's taking what or how big the pie is.
Right.
And I honestly don't think, I'm glad it's a discussion because it keeps coming up. Let's get some regulators making the final decision.
We're out of time.
Oh.
Cathie Wood, everybody. Thank you.
Andrew Sorkin.
Thank you.